episode of the Forex Beginner series. This is Jigle FX. So today we'll be diving deeper into technical analysis, particularly strategy. So sit tight as we go. First of all, we are going to talk about Forex pie chart. The Forex pie chart is just like a chart that represents the percentage of the three major aspects of Forex, which is strategy, number 2 is risk and money management, then number 3 is trading psychology. So strategy is just about the methods, the principles, or let me say the rules that you use in trading. Well, that's what we'll focus on today. And then risk management is about how you're able to manage your money in trading. You know how to the particular amount you're supposed to risk in a particular trade and not to over risk and all of that. Then trading psychology deals with you yourself, your emotions, your mind. That's what it deals with. Now, strategy is 10% of trading. Like, strategy is 10%. What we are learning, basically, all these some of the things will be seen. Strategy is just 10%. Risk management is 30%. That is how you're able to manage your money is 30%. And then trading psychology is 60%, meaning it's one of the greatest aspects of Forex. But you see, you cannot enter into trading without strategy. So strategy is important, but it's just 10. All right. And then so it's possible to have a very, very good strategy, yet you are not able to make profit from Forex, because if you cannot manage your emotions, you are still going to be in losses. So that's it about Forex pie chart. So let's delve deeper now into strategy. Trading strategy. A trading strategy in Forex is a well-defined plan, a set of rules that a trader follows to determine the following. So, rules that determine how, number 1, when you enter a trade, like when you buy or sell. Also, number 2, when to exit a trade, like at what point should I close a trade or should I go out of a trade. And then how much to risk per trade, that is risk management. Number 4, what pair or what market to trade, that's part of your strategy. Then number 5, what market condition to look out for, whether it's a trendy market, whether it's a ranging market, or trading news. So basically that's what trading strategy is about. So we are going to be heading straight to the chart in trading view, and I'm going to, first of all, I will show you generally the broad view of what strategy could possibly be, and then as we continue in the series, I will show you my simple strategy that I use for trading. So in the chart right now, this is USD JPY on the daily time frame, as you can see. But then let's park the chart to one side first. We'll come back to it, and let's just talk about something briefly here. So let me pick the drawing tool. I'm going to show you now. There's something called market structure. There's a way that the market moves. Where you see the market moving, the market moves in 3 possible ways. It moves, first of all, in uptrend. Uptrend goes like this. You see, it moves like this. Retest, goes, retest, goes, retest, breaks, retest. So this is called uptrend. All right. And then a downtrend is the opposite. All right. So the downtrend goes like this, test, breaks, retest, breaks, retest, like that. Then the third one is called the ranging market. The third one is called the ranging market, and that moves sideways. So it's not going in any direction particularly. All right, it's just at one point, just sorry, just around a particular point. So you cannot really tell if it's going up or it's coming down. So this is a ranging market, guys. So this is a ranging market. So these are the three market movements we have. The uptrend here, so you can use this is a trend line. So you see uptrend like this, then this is a downtrend like this, and then a ranging market. A ranging market, maybe we'll use a box to just show that market is ranging at a spot. So it's not uptrend, it's not downtrend, it's actually moving sideways. Now in an uptrend, this part of the trend, this part is called the high, then this is called the low, then this place is higher high. That means a high that is higher than the first one. Then this one is higher low, that is a low that is higher than the first one. Then this another higher high, then this another higher low, then this another higher high. Then here you have a high here in this downtrend, and you have a low. Then you have lower high, that is this high is lower than the first one. Then lower low, this low is lower than the first one. Then another lower high, and then another lower low. So that is it. All right, guys, that's it. That's how it is. Now this is market structure. Basically, this is how the market looks. Now these points are also called support and resistance, right? So this is resistance. The top here, the high, is resistance. Down, support. Resistance, then support. Here, support. Resistance, support, resistance. Down, support. Up, resistance. Sorry. Down, support. Up, resistance. All right, so take note of that. Down, support. Up, resistance. Down, support. Up, resistance. Down, support. Up, resistance. All right, so that's how a trendy market functions. But this is just sideways. All right, so I don't trade ranging market now, but as I drew it straight, like if you go to the chart, discover that it's not straight like that. It's not as straight as that. So look at the chart. So how can we tell what trend is? So let's come here, look at this place. Now if you look at this point very well, you will see, let's use path. So see, it goes up, or it went up like this, and it came down. You see, it's not as straight as what I drew. This is the real thing. And then it comes down, it came down, went up, came down, went up, came down, went up, came down, and then broke like this. So if you are to draw a trend line right now, all you have to do is this low here, this first low, you make sure that a trend line must touch at least, if it's in an uptrend like this, if you are drawing a trend line for an uptrend, it must touch at least two lows. Do you understand? Two lows, like 1, 2, before it is valid. All right, so 1, 2. So you can see that it still touched So you see, so our trend line actually touched 1, 2, 3, 4 before it broke it, and that breaking tells you that the trend is changing. All right, so the market was trending up, but then the uptrend was broken, indicative of the fact that the trend was actually changing. So now you can see, now this is now, so let's go now based on what we learned. So this was the high, right? Or this was the low here. All right, then this was support, then this now resistance. All right, so this is what support, all right, or a low. This is what resistance, this is what support, this is what resistance. Yes, you got it correctly. So that is it. So down, this is how we draw our trend line. You draw your trend line, make sure that your trend line is touching at least 2, that is for an uptrend, make sure it's touching at least 2 lows. Make sure it's touching at least 2 lows. So now the rule is that if trend line touches 2 lows, like 1, 2, when it comes to the third one, it bounces again. It means that I'll be expecting that if trend line if the trend line touched here and here, all right, I'll be expecting that the third time, which is around here, assuming this from here to here has not happened yet, I'll be expecting that as soon as the market comes to this place, it's going to bounce up. Do you understand? So as soon as the market comes to this region, it's going to push up. That means this is a place to buy. So when I come to this place, when I see that the market touched here, 1, 2, and then this point, now I can buy from here, which is called third trend line bounce. Remember the long 2 I showed you the other day. So you can buy from here. These are you place it here, all right, and then you set your stop loss, and then maybe you place your profit up here. All right, so this is it, guys. This is it. All right, we can see that if you trade like this, you will make profit from here, but that's not the focus right now. Let's try another instant. So let's try to draw a downtrend line. So you touch 1, 2 at least, all right, or let me put it like this here. So actually this might get confusing to some people, especially if you are very new. Let me use another instance. There's something that might get confusing to people that that are just starting out. Okay, let me use one that looks very clear there. So okay, so this one looks clearer. So you can see now, remember, a trend line must touch at least 2 points. If it's for a sell like this, if it's a downtrend, you must touch at least 2 highs. So you can see this is the first high touched, second one. So you're expecting that when it touches this third one, it's going to bounce down. So when you see the market coming to that trend line again, so what do? You now sell, because you know that the market, when the market touches the trend line, is going to be going down, it will bounce off. So you expect to sell from this point. All right, so you sell from this point, and then you place your profit somewhere, let's say here. All right, so this is it. So if you sell from there, you make profit. So this is a downtrend. This is just this small catch here. This is a downtrend like this. All right, so let's head back to what we were saying before. Okay, I just saw a ranging market. So can you see? Let's use a box to show you. Let me use a box to show you. So this is a ranging market. You can see that it's moving sideways. It's not going up and it's not coming down. So this is a ranging market. Then after this ranging market, the price broke and continued to the upside. So you see price broke, continued to the upside. So you see it created a higher low here, and then it continued to the upside. we've talked about trend lines. You can just go back to your chart and try as much as you can to draw trend lines, right? Draw it. Remember the rule: you must touch at least two highs if it's in a trend like this, a downtrend. So you can see this. So we have this touch here, this second touch here. So if the market, if all this thing had not happened this side like this, it means that if the market came to this point, if the market came to that point there, then this point here, then we'll be selling from there. So let's use that tool and see that sell tool. So if you use the short position tool from this point, using the short position tool from this point, so you adjust here, this your TP. You can see down there is written target. Then this one here is your stop loss. That's, I've talked about stop loss before. You are setting your loss limit, like that's stop loss. So if you enter this trade, you will see that you are going to make profit if this was a live trading. So now let me show you something in this tool, right? So when you look here up, you will see stop level. This is showing you what you are risking. All right, and then actually this market, this US 30 market, this is actually a stock indices. So if you look at this place, you will see targets now. So that is telling you what you are risking. Then when you look at this place, you will see risk to reward ratio. That's very, very important. And the risk to reward ratio is 2.96. It's like 1:2. We call it 1:2.96. All right. If it is 3, then it's 1:3. If it is 4.5, then it's 1:4.5. And that is very important. What that means is that if it is like the way it is like this, okay, let me adjust a little bit to, let's say it is, the risk to reward is like 3. So this risk to reward now is about 3. All right. The meaning of that is whatever you are risking, you are making times 3 of it. That is the meaning of risk to reward. So you see that it's very, very important. If I start explaining my own strategy, I'm going to talk more about that. So these are the places, very important points to look at in this long and short tool, position tool. All right. So that's it about trend line. There's another thing I want you to learn. Is called Fibonacci. Another tool here, Fibonacci retracement. Now Fibonacci is actually, it shows you level of possible points where the market can retrace. Now what is retracement? Now we've talked, I've showed you before that the market doesn't move straight, it moves in waves. So it creates high in an uptrend and then it breaks the high. So this high is broken, the first high, this high here is broken right now, and then it turns it to support. That is resistance broken, turned to support. So this is another support created, then broken, turned to support, resistance broken, turned to support. So that's how the market moves. I've told you that before. So this is actually this one, this is resistance, and the resistance was broken, and when the market came back, it turned that resistance to support, like support. All right, and then it broke that resistance again, turned it to support, broke, and then like that. So that's how the market moves. Resistance turned to support. Now this move like this move, an impulsive move. It's called impulsive move. Then this is correct retest. All right, this is retest. This impulsive move, and this is retest. Now if you know the place the market can possibly retest, you can tell where, at what point you can possibly buy this market. So if the market, if price was going like this, assuming price broke this first high here, and then it went like this and it's coming down. If you know the point where the retracement can possibly stop, then you will start buying from there so that you make profit as it starts pushing up. So that is there's a way to do that. It's called Fibonacci. So now let me show you the tool now. Fibonacci retracement, Fib retracement. So when you want to use Fibonacci, you go to the low, the recent low. That is the sorry. So assuming let's assume that this thing have not happened, like this place is out, like from here to this place is just out. Assuming the market is around this point, just went up and is coming down, and you want to check where it can stop, like down, where it can stop before it continue moving up. Like assuming the market came like this and went up and it's coming down, but it hasn't reached this point yet. So you want to know at how far can the market drop before it continues going up. So when you know how far, then you can, when the market comes to that point, you start buying. So that's where we need Fibonacci retracement. So there's a tool like that. So this is a Fib retracement. So you use Fib, the low the market created, you place it there, click, and then drag it and keep it in the recent high it created. So you see now in Fibonacci, there are 3 golden levels, 3 very important levels in Fibonacci. So it is this 0.382, 0.5 and 618. Prices easily or mostly react around this key level. Mostly they react around this level mostly. So now if you look at this stuff here right now, you will see that price actually reacted. Look at it. Price actually reacted around 0.5 Fibonacci level. Are you seeing it now? So you can use Fibonacci to know where possible retracement will stop. So let's try to use Fibonacci in other directions. So assuming the market broke like this, came down here, all right, okay, no, like assuming the market like, okay, it has, yeah, assuming it has retraced, sorry, so that it came like this, went up, and it's now coming down, but it hasn't reached there. So you want to know, as the market has bent now and is coming down, at what point can you possibly start buying? So you now use Fibonacci to check. So if you want to use Fibonacci, place it here, place the point here, then draw it up. You are dragging it towards the right hand side. So you drag it and keep it up here, keep the top of it here, then you will now start checking where the levels are. So let's try to use Fibonacci right now. So we'll first of all place Fibonacci down here, then you click. After you click, you now drag it, move to the right like that, and then you keep the top in the high there, like this place here. So you can see now look at it, see 0.5 again. So when it came around 0.5, it respected it and continued to the upside. So you can use Fibonacci to check where possible retracement. So this thing, this turn, as the market was going up, so it was going up, then it will retest. So this now retracement, this move, it now retraces and continues in the up direction. So that's how we use Fibonacci. All of what I'm saying, you can go practice more on them, so you can see it. All right, so let me try it out again. So assuming the market came down like this, moved up, and when it moved up, it's actually came down like this. Sorry, I'm not confuse you. Now if the market came down like this, and when it came to this point, it starts moving up. Now before it gets to this level, you would want to know where the market will stop. As this is called retracement. When it's turning like this, retest, sorry, when it's retesting, you want to know where the retest will stop. So you now use Fibonacci so that you can sell from there downwards. So you use Fibonacci retracement. All right, so you place it first of all for this sell downtrend. You place it here, then you drag it to this point here. You move it to the right like this. So now let's look very well. Now if you look very well, you will see that the price reacted around 0.5. It came close to 0.618, but then remember, these are the three golden points. These points are the three golden levels of Fibonacci. So go ahead and play with Fibonacci in your chart. You can go ahead and play with it. Let's try another one. Let's try another one there. So when the price came down to this level, you want to know, as it's going like this, you want to know where it will stop, where it will retrace before we can sell down. So we'll go again and then take our Fibonacci, place it in the high, recent high, then sweep it down, swing it down, and then you drop it in the recent low there. So you can see again that the market reacted around 0.5. all right, so it's not always 0.5. Sometimes it can be 382, 0.382 or 618, 0.618. So that's how we use Fibonacci. I would not want this video to be long, so let's try to use Fibonacci on the chart here. Now look at it. Try to use Fibonacci on the chart. As you can see, this is a trending market. Fibonacci only works in a trending market, and there are two types of trading market: uptrend and downtrend. If the market is ranging, you can't use Fibonacci. So the market created a high here, came down and retested. You see, when it reached this point, it came down again, all right, and then it retested and reached this point, came down. So this is a downtrend, and you have learned trend line, so we can use trend line like this. So if you use your trend line, you see what we are having here like this. So now let's try to use Fibonacci here on this downtrend. So let's go there, Fib retracement. So you place it here and then you drag it down. This is the low here, this point. So you drag it, then you move it to the right. Now let's come closer and see. So as you can see right now, the market, when the market came down like this, it retested. All right, now look at it, 0.618. When it touched this line around 0.618, it continued to the downside. Are you seeing it now? So let us try to use Fibonacci in the second point here. Now this was the high the market created. All right, this was a recent high here. So we drag it to the low, which is here like this, and then drag it to the right. So you drop it there. So you can see that now when the market came down, as it was retesting, it came around 618. You can see 618, it now continued down. So that's how we use Fibonacci to check. You can play with it on your chart. Your Fibonacci might not look like my own because I edited everything on my chart here. I edited it to my own pleasure. You can use this. If Fibonacci, now these things don't always work. Nobody is a lord of the market. Do you understand? You are not controlling the market react. So for an uptrend, you drop it like this and you move it up. You see that? Now look. So when the market came around 0.5 and 618 here, remember I told you that the three levels are very important. You see that the market came around this 0.5 and 618, and then it continued moving to the upside, right? That's how we use Fibonacci retracement. If you have a question, you can drop your question. All right, this is actually US 30. US 30 is a stock indices, like I said. So we're going to stop here. Uh, if you have a question, drop it in the comment section. Next episode will still continue on strategy. This strategy is very broad, so we'll continue on it. All right. So thank you so much for being part of this fourth episode. Catch you in the next. Peace out.